We got two deal makers here who actually lived through 2008 and were on all sides of it. Former SEC Chairman Jay Clayton is here. He's a CNBC contributor and now executive chair of Apollo, American Express board member and senior policy advisor for Sullivan and Cromwell, the Jay Clayton portfolio of life. And Gary Cohn, IBM vice chairman and former National Economic Council director, and of course, Mr. Goldman Sachs during the 2008 crisis. Okay, so what do you guys think of this? Is this what you expected? I mean, I think there were so many people who were concerned after 2008, actually, and the experience that JPMorgan in particular went through in terms of legal liability, that there was a view that actually some of the big banks wouldn't want to touch something like this.
So I'll kick it off. So, look, I think this is what it was expected, but I'm surprised that it took this long to get here.
Right.
In fact, I think one should be shocked it took this long to get here. I think everyone knew that First Republic was in trouble 3 or 4 weeks ago. And the assets just deteriorated. Deposits continued to leave the bank. The bank put out earnings, which the regulators knew what the earnings were long before they put them out. I think it would have been much more prudent for the regulators to have stepped in pre-earnings and try and
so that's actually very interesting.
It was waiting to see what the deal was going to be. The regulators wanted a private deal. The private investors are like, forget it. We want the best deal we can possibly get.
Actually, well, you know, we talked about this. Yeah. The longer you waited as a buyer, the better deal you got.
Exactly.
Right. This was the falling knife.
Which is why we didn't get the press release until 3:45 in the morning.
But should have this been forced? I guess where you're going with this, and I think a lot of people were going with this, is this should have been forced, if you will, 3, 4, 5 weeks ago. I mean, there's some question as to whether this $30 billion program, if you remember when all the banks came together, led by JPMorgan, in fact, should have even happened.
Yes. Look, the question is, have we created the new moral hazard? And the moral hazard now is never buy a bank until it goes into receivership.
But we already knew that after what happened in 2008.
You're going to get a much better deal when it goes into receivership. So, yes, everyone knew that the First Republic was going to transact 3 or 4 weeks ago. But 3 or 4 weeks ago, you weren't going to get loan sharing. You weren't going to get loss absorption. You weren't going to get a line of credit from the FDIC. You were going to have to go in there as an arm's length deal. When the FDIC takes it over and puts it into receivership, it's a whole new deal.
Right. But Gary, wouldn't you say that part of this was lessons learned from 2008, whether that be Bear Stearns or anybody else? Like, why would you want to step in as a big bank knowing all the bad things that happened last time around?
I think this is different than 2008 in some respects, and Jay would have a very strong opinion with that. In 2008, you were taking over mega mortgage servicing portfolios, and the mortgages were the culprit of the time. The issue going on right now was a deposit run and a mismatched duration interest rate book.
Right.
There's a lot less ramifications from a mismatched duration and interest rate book than there is in originating mortgages that maybe should not have been originated. There's a much longer tail on it.
Right.
But Becky's right. The structure of this deal has embedded in it the lessons of 2008. They structured the deal to avoid some of those liabilities that basically came along in unexpected liabilities.
Well, let's talk about those liabilities. Are there legal liabilities that come with a transaction once it's in receivership? Which is to say, effectively, can shareholders, can individuals, can the government or governments, agencies sue you, meaning JPMorgan, over things that happened at First Republic over the last decade?
Okay, that question was litigated coming out of 2008, and as usual in the world of what I would say is legal liability, facts and circumstances matter.
Okay.
So, but you can tell here that this was structured, and it should be structured to avoid those things.
So you think those liabilities are now off the table?
If you want a buyer to come into these kinds of situations and do due diligence in the space of 3 or 4 weeks. You can't say, oh, by the way, you've got to take as is, where is, including all of the liabilities. Otherwise, what's the price? If you have to discount for those liabilities, the amount of support the FDIC is going to have to come up with is going to be much larger.
You made a note to yourself. What was the note?
No, it has nothing to do with this topic.
Okay. No, but I
was thinking about
he's always a step ahead.
One step ahead. He's always one step ahead.
But do you think there's legal? I mean, we don't know that there's no legal liability.
We don't know that there's no legal liability, but let's just take a step back. Should the buyer be assuming legal liabilities in these kinds of situations? Because it will skew the price lower by a substantial amount more than the expected legal liability.
I have a strategy question, which is to say, the bank, JPMorgan, saying this is going to be accretive to them. I think, frankly, minimally accretive to them.
Yeah.
Do you think that this is actually a good deal for them? And the reason I ask is a lot of deposits, frankly, were already going to JPMorgan, right? They were already there. They don't really want to be in the super jumbo mortgage business. In fact, they've sort of gone away from that business. To the extent that it's going to help their wealth management business, they already have a pretty healthy wealth management business. How does this help them relative to a PNC or, I mean, Bank of America, it sounds like, dropped out probably, I think, on Saturday. But how do you think about sort of what this does or doesn't do to the bank?
Look, I think it's a good deal for the system, right? I mean, and if you're...
I don't disagree with that. I'm saying a year or two from now, our shareholders of JPMorgan are going to say, I'm so glad that JPMorgan and Jamie Dimon stepped in, or are they going to say, I prefer they wish they did?
Andrew, relative to the size of JPMorgan today, this is not that relevant. I don't think shareholders are going to notice 3 years from now. You're talking about a multi-trillion-dollar bank buying a bank with $100 billion of assets. I mean, it's a really small transaction.
Maybe on the wealth management side.
Do you see? You say maybe on the wealth management side?
Maybe on the wealth management. Look, First Republic had a great wealth management franchise, great connections.
But the question is, does that wealth management franchise hold up?
You
can't offer them, basically ridiculous mortgage prices.